What is up, people? Miles here with Keep the Change, and today we are talking about the best dividend stocks for 2021. And I'm going to be talking about stocks in different sectors and different type of industries, so hopefully you guys enjoy, hopefully it's entertaining, and thank you guys so much for all the support on the channel recently. It's been really amazing. You know, every comment, every like, it all means a lot to me. And if you haven't already, make sure to subscribe. I upload videos twice a week, every Tuesday and every Friday on the stock market, so go ahead and subscribe and stay tuned so you don't miss out on any. Now, when I look at dividend stocks, I don't just look at the dividend yield and I'm like, oh, hey, a 10% yield, that's really high, that must be good. Okay, it's a lot deeper than that. You got to actually look at the business, where it's going, if they can pay the dividend, the payout ratio, the growth rates, all of that stuff we're going to look into on a deeper level here. So the first dividend stock I would look into for 2021 would be Lockheed Martin, which trades here at $360 per share here today. This is actually a company in the defense sector, or the military industry basically, as they design aircrafts and jets and missiles and a bunch of military personnel for the government, mainly the US government, as that's where 70% of their revenue actually comes from. Now, the US government loves the military, okay? I think that's no secret, that's no surprise. They spent over $700 billion on military spending in 2020 alone. So that just points out that the government being their main customer is a very good thing, because that just basically means they're going to have stable business no matter what the conditions are, and they've actually grown their revenues this year, and in 2021 they're thinking they're going to grow their revenues again. Now, actually looking at the dividend, it's around 3%, so every $100 you put into this company, you're going to get $3 back. And the payout ratio is pretty low at 42%, which basically just means that they have a lot of room to grow that dividend and pay even more to you as a shareholder in the future. And they have paid revenues for 17 years straight, so obviously that's a very good sign, because back in 2008, 2009, that was a very financially troubling time. Obviously, we had the Great Recession, you know, the housing crisis, and they were still able to pay dividends even back then. And for the past 3 years, the growth rate of that dividend has been 10%. So that's pretty good as well. They've been growing the dividend on average 10% per year. But what actually excites me the most about this company is the valuation. I think it's extremely fair. You're getting a really good deal. You're getting a great company for cheap. So the PE on this company is 15, then you got a forward PE of 13, so that's already incredibly cheap. But then when you consider the fact that this is the cheapest it's been all year, it's an even better deal, which makes this stock a great dividend stock for 2021 with that 3% yield and low payout ratio. And the stock price has fallen here recently from like 380 to 360. This was kind of after Biden got elected. This kind of introduces some new uncertainties into this stock. Are Democrats going to spend as much on military as Republicans would? People have to ask that question. It's a fair question. I still think the government is going to spend a ridiculous amount on military. Okay, it's the US government. When have they ever done anything right? So this next one on the list, it's a little riskier, got a better yield on it, but keep in mind, higher risk, higher reward type thing. And it's actually a real estate company called Store Capital. And I heard about this one because of Joseph Carlson. So shout out to Joseph. This stock here today is trading at $32 a share, and it's got a market cap of around $9 billion. So not too big of a company. And Store Capital is a real estate company. They actually lend out properties to businesses. They have over 2,500 properties as of September 2020. And what's gotten this stock a lot of attention in recent times is the fact that Warren Buffett has actually bought in. That's right, Berkshire Hathaway actually has a stake in this company, around 10%. So when the god of investing himself, Warren Buffett, comes in to buy a company, you know they're doing something right. And personally, I do see a lot of upsides for this as a dividend play. If you take a look at this graph, compared to its peers, Store actually had the highest growing dividend for real estate stocks in the past 5 years. And they rent out their buildings to a bunch of different businesses. This could be schools, this could be movie theaters, restaurants, anything you can imagine. So you would think that during this time, you know, 2020, a bunch of places are closing, then maybe their business would be hurt. And actually, they have been growing revenue year over year. So 2020, they actually made more money than they did in 2019, although their profits have taken a bit of a beating. And not only that, but they actually increased the dividend from 35 cents a quarter to 36 cents a quarter back in like September 2020. So even though there's an entire pandemic going on, which kind of makes rent harder to pay for small businesses, they actually increased their dividends, which shows that they're confident in their abilities to get payments. Now, the actual dividend yield on this company is 4.5%, and the payout ratio is around around 76%, which seems kind of high, but when you compare it to other stocks and companies in the same sector, it's relatively low because most real estate companies have payout ratios of 80 or 90%. So 76% in comparison, pretty low, pretty good. Looking at the actual valuation on the company, it's got a PE of 37 and a forward PE of 39, which seems kind of high considering that the growth isn't that great. However, if you look at like Realty Income, that's got a PE of around 50. So in comparison, that's kind of a good deal. Overall though, I think this is a great pick for 2021 as the economy gradually recovers, their business picks up even more, they increase the dividend even more, and yeah, I think it's just a good pick. I mean, it's a slightly riskier investment than Lockheed Martin, but it's got a lot more upside too. The next one on the list is one we definitely all know, regardless of whether or not you invest in stocks or you're just an amateur, you are going to know this company, and it's PepsiCo. So Pepsi's a $145 stock, got a PE of about 28, and the dividend is $4.09 per year, or about 2.8% yield. And the payout ratio is only 74%, which is a little on the higher side. It's not amazing, but it's not bad either. It's not like 80% or 90% where it starts getting kind of questionable. On top of that, Pepsi has paid dividends for 48 years straight, which is absolutely crazy. I mean, just think of how many things have happened in 48 years. You've had so many different recessions, new technologies, a pandemic for Christ's sakes. I mean, you have a lot going on and this company is still paying dividends. Because at the end of the day, Pepsi is everywhere, okay? It's a company that's never going to go away. If you go to a store, you see Pepsi. If you go to a gas station, you're going to see chips, you're going to see drinks, you're going to see everything they offer, which is another thing I love about this company. They're not only in drinks like Coca-Cola, they actually own a lot of chips and snack brands as well. And you may be asking yourself, you pick Pepsi, why did you pick Pepsi over Coke? I mean, Coke's the better drink, right? Shouldn't it be the better business? Well, first off, Pepsi is massively underrated in my opinion, but I do agree Coke is a little bit better, okay? It's got that edge, but Pepsi, it's still good. But the reason I picked Pepsi over Coke is just because Pepsi's doing a lot better during this pandemic. Coca-Cola's revenue for quarter 3 of 2020 was down 9% year over year, and Pepsi's was actually up 3%, so that is a massive difference. Coca-Cola as a dividend stock does seem a little better at first glance. It's got a yield of 3%, so slightly higher than Pepsi's 2.8% yield. However, the payout ratio is also like 90%, so way higher, way less room to grow the dividend. When you couple that up with the fact that Coke is actually decreasing in revenue while Pepsi is growing, that just means that eventually if Coke doesn't come back, they're actually going to have to cut that dividend while Pepsi could still grow it. Not only that, but if you look at the dividend growth rates for these companies, Pepsi has a higher dividend growth rate than Coke, just flat out. Way better in terms of growing that dividend. Also, Pepsi is just a better diversified business in terms of the fact that they do have snacks in their product mix. I mean, Coke is basically just drinks. So yeah, Pepsi is a really stable stock. I mean, great dividend play. I would get some shares for 2021. I think it's at a fair valuation here. It's always going to be a nice dividend in your pocket. So those are my dividend stock picks for 2021. Let me know what you guys think in the comments down below. What dividend stocks are you buying? I would love to hear. Thank you guys so much for watching and love you.